Welcome, everyone. I'm Mike Bershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journeys, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to another exciting episode of the What Matters podcast. I'm your host, Mike Bershazadeh.
And I'm Ashley Ward.
Today, we're excited to have two special guests with us, Rob Bartenstein, CEO of Kestra Private Wealth Services, and Scott Wilson, Senior Managing Director and COO. Both are influential figures in the financial services industry, helping shape the future of independent wealth management. Welcome to the show, Rob and Scott.
Thanks. Good to be here.
Thank you. Appreciate it, Mike and Ashley.
Well, we're very excited to have you both on the show today. Lots to talk about. So let's dive right in. We want to start by talking about each of your origin stories a little bit. Rob, we'll start with you. You've had a dynamic career starting in private banking and eventually becoming the CEO of Kestra Private Wealth Services. Can you tell us more about your journey and really some of the pivotal moments within your leadership roles that have led you to now your role as CEO at Kestra? And how has your experiences really shaped your approach?
Yeah, thanks, Ashley. I think from my perspective, without boring everybody with the details, Scott and I both spent a long time as financial advisors, working for similar firms. And when I got out of law school, I went to work for a firm up in New York that doesn't exist anymore called Donaldson, Lufkin and Jenrette, which really gave me a different perspective on the business. It was really a pure private banking kind of experience. And that firm became Credit Suisse First Boston. And through a series of events, I ended up working in Washington, D.C. when they decided to kind of reorganize the company and move people out of that office back to New York and other places. And so my partner and I at the time took the opportunity to move to Merrill Lynch in the Washington, D.C. office and had a great, we had a great career. We focused on family offices, corporate executives of publicly traded companies and things of that nature. So very exciting, interesting people, great stories to tell, and, a lot of sights and scenes to behold for a kid that didn't grow up with a whole lot of money. And somewhere along the way, got asked to take over the training program for Merrill Lynch in Washington, D.C. And that turned into kind of a passion project where, it was almost like being a college professor. We had 40 people in that class. They're all trying to make it in the industry. And along the way, I found out that I really liked helping other people do this business as much as I liked doing it myself. And along came an offer not too long after that to potentially move to the West Coast and work for Morgan Stanley full time on the management side. And it was a really hard decision. And I always joke that, one of the great things about being married to the right person is you can get good advice. And if you're smart, you can take it. And I went home probably on the last day of having to make this decision and said to my wife, I just don't know what to do. I can't decide whether I should leave all the blood, sweat, and tears that spent the last 10 years building and then move to the West Coast. And I don't know. And she said, you get these $1 billion clients and you come home and you make a martini and we talk about it for 5 minutes. And then you help a kid get a $500,000 IRA and I hear about it for 2 hours. She's like, I think I know what you like to do. And that really helped tip the scales for me. And so I ended up taking a job at the regional level in San Diego for Morgan Stanley on the sales side. And that's frankly where I was fortunate enough to begin working with Scott Wilson, who was running the largest complex for Morgan Stanley at that point. And I got there in August of 2008, and it wasn't shortly thereafter that the whole world basically blew up. And Scott and I worked together for a few years through the worst environments anybody's ever seen. And ultimately, that sort of becomes the origin story for what is now Kestra Private Wealth Services. And I'll let Scott, share his side of it.
I had a quick question. Out of the 40 guys that you had and gals that you had in the program, how many would actually make it through?
Well, more than we're supposed to, and not because we were easy on them. I think it was honestly the other way around. This is just old guy commentary on the modern business. I don't think these days people are allowed to be hard enough on trainees to get them in a position to exceed expectations or win on their own. I think nowadays we've definitely pivoted to let's put these guys and gals on a team. Let's surround them with experts. Let's kind of prop them up, give them a longer salary runway and things like that. It wasn't like that back in the old days. You had to eat what you killed, and you had to do it in a hurry. So the tactics that we had to kind of enforce discipline and hard work and get in early, stay late, work weekends, those are all sort of relics of a bygone era. But we did really well in terms of graduating people that went on to become successful. It's a low percentage of success no matter what in this business, no matter what you do. But we did manage to have a pretty good run.
Oh, thank you for sharing. I appreciate that. I appreciate your answer as well. I think it's, that has gone across, multiple industries, not just this one.
Yeah, that's probably right.
Yeah. And thank you, Rob. So Scott, tell us a little bit about, your origin story before meeting Rob and building Kestra.
Thanks. I appreciate it. I have similar sort of story to Rob, other than I'm a bit older than he is. So I've got a few more years at it. But I started in 1986 with Edward Jones in Montana, where I grew up. And, was lucky enough after getting an accounting degree, which, I thought that's the direction I wanted to go. I was lucky enough to meet a gentleman at Edward Jones, and I became a financial advisor at the age of 22. I played college basketball, and it was a competitive arena, being out with Edward Jones, going door to door. So I was lucky enough. I was young, hard-headed, and sort of was able to make it in the industry back in the late 80s. Ultimately, like Rob, went to Merrill Lynch in 1995. I became a producing manager in Missoula, Montana. And both had a book, predominantly in the western part of Montana with ranchers and folks that I grew up with. Also was a trainer and a recruiter like Rob was. Ultimately, they asked me to go into full-time management in 1998, and I was asked to give up my book of business, which I did painfully, and went into management to Denver, Colorado, where I was a sales manager for a large complex, sort of in that prototypical large wirehouse management training program that both Rob and I were in. Went into being a complex manager in Colorado Springs, and ultimately was promoted to be a complex manager at Merrill Lynch in San Diego, California. So I moved to San Diego in 2001. And I think, like Rob, I always enjoyed being on a team. I think the reason we make a very, very good mix is that I was always sort of in the trenches with my accounting. I'm a recovering accountant with my accounting background. Rob's a recovering attorney. I think, I was able to sort of roll up my sleeves and felt comfortable digging into issues in a branch level. And Rob was really good at strategic and the types of issues that went on at a regional level. And when we sat down after, we were at Morgan Stanley after a regional meeting, and we were exhausted. We came back from a meeting where we had to go back to the branch and probably, deliver a message that wasn't in to the benefit of the advisor, but more in the benefit of Morgan Stanley. We just said, look, it's time for us to do something different. So in 2010, we on the back of a cocktail napkin, I'm sure after a couple drinks on a flight home, we came up with a plan which we thought ultimately we stuck with, and that was 2011 when we exited from Morgan Stanley and made the change.
Oh, wow. So you guys were with Morgan Stanley during the 07, 08 hit there.
We were. Yeah.
Good times.
It was a difficult time, but I think it's when we realized how much we were alike in terms of our desire to sort of get back to our roots, small company where we could make decisions again, because most of the decision-making authority, and Rob will tell you this, was taken out of our hands at least at the complex level. Rob had a little bit more at a regional level, but we became recruiters and people retaining and begging people to stick around through the 08 and 09 crisis.
Yeah, and I think our background as advisors was really what brought us together. And, we spent a lot of time working on projects to try and hold things together in that 08, 9, 10 period. And look, objectively, I think we did a pretty good job. The way that Morgan Stanley ranked us and all that stuff back then, we were, as good as the folks in New York, which was kind of cool. But it was also super frustrating to be in an environment that was not the way we had grown up. It was not the way that we had been brought up in the business. And it was no longer about the advisor and the client and what we could do to make that relationship really work for the benefit of the client. It was much more, as Scott said, about what the advisor could do to benefit the firm. And look, that's a business plan, and there's nothing wrong with that. Again, I'm speaking as objectively as possible. It's just not how we wanted to spend our days. You remember the old cartoons at the drive-in where you follow the bouncing ball and you can sing the song, and that's sort of what it felt like to us. And that wasn't going to be anywhere nearly fulfilling enough for two guys who'd been successful financial advisors and then given that up to go, try to help people build businesses, which was what really, flipped the switch for us. And so when we started to put our heads together and think about an alternative to an environment like the one we were working in, it wasn't really hard to come up with the basics of what you would need for folks like us who were still advisors, but maybe wanted to get out and go independent. Just put ourselves back in those shoes and say, what were the 4 or 5 things that we would want somebody to do for us? What would they be? And that became the basis of the business plan. And we now call those the 4 pillars of the business. But it really shaped the business plan and ultimately led to getting capital to pursue it and build the business from the ground up.
And so you guys had started Kestra in 2011. Is that correct?
So we started a company called Washington Wealth Management, which rebranded to Kestra Private Wealth Services in 2016. Yeah.
Can you tell us about that?
Yeah, sure. So that was a coming together of some like-minded folks with an investor back in Virginia, where I'm from, who saw the vision and believed in the plan, staked us our first $10 million, and we were kind of off and running. Everybody quit their jobs and we went all in on this business plan. And, Scott and I always joke and laugh. I mean, it's easy to look back on it and laugh now, but it wasn't funny at the time. We thought it was going to be a really rapid ascent. We thought we had figured it out and we knew what people wanted. And when we threw the doors open and waited for everybody to come rushing in, they didn't, and so that was a bit of a wake-up call. And I think a lot of entrepreneurs can relate to that. We've got this bright idea. Where the hell is everybody? And, I guess in retrospect, as hard as those years were, what we did was we accidentally found the time to really refine the model and figure out what worked and what didn't work. And we made some pretty solid mistakes in the early days. That fortunately weren't fatal, but things that we wouldn't do again and practices and procedures that we knew we needed to change. But we had time to figure it out. And, we always laugh now. Occasionally there's an industry magazine or something that covers us and, sort of treats us like an overnight success. And yeah, we're the overnight success. That took 10 years to become an overnight success. So, it's never easy starting anything from zero, but we had good people with us and good fortune and a little bit of luck, and the trend caught up to us. So we were early, but in or around about 2016, 2017, this wirehouse moved independence really caught fire. And at that point, we had sold the business to Kestra and become a wholly owned subsidiary of Kestra, which is how we operate today. And the reasons for that are, there are a lot of them, but the primary reason for that, going back to what I've already said, is that we learned pretty quickly that this type of business is seriously capital intensive, and you need some deep pockets and some people that really believe in your vision to back you up. And the folks at Kestra did both of those things.
So how long after you guys had gotten started, that statement resonates with me quite a bit as an entrepreneur, right? And, everybody that probably told you guys, oh yeah, as soon as you get started, we're hopping on board.
Yeah.
Right?
Yeah.
you got their contracts, and then and then all of a sudden they go dark on you.
Those were all Scott's friends, by the way. Mine all came.
I tracked the numbers, Mike. I mean, if you sort of look at where we were at when we were purchased by what is now Kestra over 10 years ago in 2014, we had 7 firms. We now have close to 70 firms, right? So I think over the first 2 or 3 years, we had some changes in the sort of leadership group that came about. And we need, like Rob said, we were learning exactly what the right mix of capital, payout, platform fees, and support. We were really unique that we're really the only firm still that does real estate into perpetuity. And that was a big capital expenditure for us. And we, now have over 70 locations. We're, running, we always joke, we're running a mini REIT. So it took us a while to get there. Our ramp up, once we partnered up with Stone Point Capital, when they ultimately sold to Warburg Pincus, our private equity backers, when Warburg Pincus came into the picture in late 18, early 19, they were massive supporters of the wirehouse Exeter model because many of them came from that industry. And I can tell you, with increased capital and really their support to really get after it in a positive way, we made some massive moves in 18, 19, 20. We literally doubled our recruiting every year after 21, 22, 23. We had a record year last year. And this year we're ending with one of our strongest fourth quarters ever. So I would tell you the last 5 years have really been a hockey stick. But as Rob said, it took us a while. We had slow and steady growth through 18, 19. But, thereafter, we plan on being at 100 firms by end of 2026. And that was our goal, to get 100 firms doing $1 million. And Rob and I smile now. It's certainly changed that we're going to have 100 firms, probably with an average production of around $2.5 million of revenue per firm. And that has been a pleasant surprise for us.
That's great. And going back a little bit there, after starting the firm, when you said that it took a little while to start, was it kind of a gradual, did things gradually take place, or was it just kind of nothing happening and then a bit, a big helping of pie there?
Yeah, I think the better way to describe it is it was incremental improvement year over year over year. And then, I don't know, I think I said earlier, like 17 for sure, 18 for sure. The trend and our business intersected and it just launched. And so, we had been working on the model and running the business for the better part of 6 or 7 years by the time the floodgates in the wirehouse really started to open. I mean, we had maybe one Merrill team at that point, and now Merrill is, maybe 50% of the flow in any given year. So something changed, and then COVID just pushed everything into overdrive. I think a lot of people realized being stuck at home may not have been perfect, but it sure as hell beat being in the office, and that they didn't really need all of that to operate, and frankly felt a little more comfortable without it. So the entrepreneurial spirit definitely caught fire in the wirehouse space. And, Scott and I, we spent a lot of years in management telling that story that, you're an entrepreneur. You work at Merrill Lynch, you're an entrepreneur. You work at Morgan Stanley, you're an entrepreneur, but you're really not, and I think everybody kind of knows that. When the decisions got hard, or when the decisions were something that the firm didn't approve of, then it was a business decision for the advisor to pay for it. Well, that's one thing when you're getting, 70 or 80% of the payout. It's a whole different thing when you're getting 40% of the payout, right? And the firm's getting 60. So our model was about let's do for our friends, really. Let's do for our friends what we would have wanted somebody to do for us. And how can we kind of stand this whole thing on its head, invert the paradigm across the board, whether it's payout or business ownership or what have you, and really set people free to take all the experience that they've gained being advisors in those big firms and just set them free to be the business owner, to run the business, to have their own logo, their own brand, their own office layout, their own office design, all of that kind of stuff that really inspires people. And what we ended up with was a group of folks who love what they do every day, who always say they wish they had done it sooner, who on the first day in their offices and Scott's team are the ones that build those, and they're each custom made for the folks that work in them. First day in their office, they're literally in tears. Like that vision that comes to fruition right in front of them. I mean, this is the stuff that is so inspiring to us in terms of running or leading the back office side of a business. But they're our client, and so when you draw this circle, you can go all the way back to when we were financial advisors. We never have lost sight of the fact that they are our client. Our business plan reflects that. The way that we treat them reflects that, and they know it. And it's not just, those aren't just words that we say to sound nice. Like, we work for them, and that model really works, and it lets everybody run at their fastest speed and achieve their fullest potential. And to us, it's like we really couldn't be more fulfilled than doing what we're doing.
And I think you look at that, to add to Rob's comments, we learned along the way. I mean, I know we talked a little bit about secrets to success. We realized early on, we thought, and we didn't have the capital, right, that we had ultimately when we joined up with NFP, what is now Kestra. We thought we could open up multi-advisor offices and have 10 big hubs around the country. We had to pivot, and we learned quickly that advisors want to have their own brand in their own space, and they love their friends, but they're sort of over being in an office with 50 other advisors. We had to pivot. And I'll tell you, it was more expensive to do offices for every firm. But the minute we did that, and we started, like any business, start getting referrals from our existing advisors, then the business took off. Because, when you get a referral from an advisor, they're more willing to come listen to us than have us try to sell you something. It's their buddies and friends telling them, hey, these are guys that are honest, they're transparent. And we became extremely confident that we knew we had a good model. Like early on, you're questioning a little bit, like, gosh, maybe we're not hitting it on all cylinders. But I think around that 17, 18 timeframe, we realized we do have a good model that is viable with a great partner in what is now Kestra. And once we took that support question off, and are you going to be here tomorrow question, and we started growing rapidly with that backing, the business did really take off.
And let me ask you this: in total, you guys said you have about 70 different firms there. Where's your guys' AUM at today?
Yeah,
I always get information from Discovery, but I don't want to be
total.
So I'll ask a question.
Yeah, we got total AU. So AUA, we're a little over $14 billion for private wealth, right? We're just talking about the private wealth division. AUM, strictly advisory, we're a smidge over 10 billion. So between advisory, brokerage assets, we've got over $2.5 billion. And then the remainder is sort of annuities, direct investments, 529s, retirement plans held at mutual funds. But everything under advisement, we're over $14 billion.
Oh, congratulations.
And
as a firm, I think Kestra as a whole, probably 150 billion-ish all in. When you look at the numbers, I think we're over 80 billion in advisory on the Kestra as a whole. And we are, probably the fastest growing portion of that ecosystem within Kestra.
It's really cool.
And so what were you guys at before you rebranded 10 years ago to Kestra, and that happened? What was your AUM at before at Washington?
I'd have to look back, but I think in 14, when we were purchased initially, before we rebranded to Kestra Private Wealth in 16, in 2014, we had 7 firms. We probably were in the, $1.7 billion, $2 billion range at that point in time. In 16, we had added probably another, by the end of 16, we probably had added another 6 or 7 firms. We probably had doubled in size. But the real growth this year within recruits, we recruited last year $4.7 billion of new AUM in 23. And this year, we're going to recruit a little under $4 billion of recruited AUM as well, coming from the likes of Edward Jones, Merrill Lynch, and other RAs.
And
Yeah.
so you guys have recruited close to 5 billion last year, and then again this year.
We did,
Well,
yeah.
at 4 and change.
Wow.
I'm a rounding man, so that is awesome. I mean, that is some spectacular growth. And let me ask you this: Are you guys, how do I say this? Are these inorganic acquisitions that you guys are taking debt out for? Or are they people that are just joining the platform?
No, so I think it's important to talk about this because what we're not doing is taking everybody that we get in front of. People can make their own minds up about how that sounds, but we are not in the business of taking anybody who wants to come. And I think for all the right reasons. I mean, we've reached a point in our evolution where we're probably sometimes maybe even more selective than we ought to be, but also protective of the ecosystem that we've built. So our advisors that are here depend on us to make sure that the people that we allow in fit the mold and fit the culture and, are not going to be disruptive or ruin it. I mean, I don't know how else to say it, but I think that's another element of uniqueness. And I know a lot of people say that, but I'm just telling you, this is how we do it. And that might turn some people off, but we're okay with that. I mean, with us, with Scott and his team on the pro forma side, you're going to get ultimate transparency. You're going to get a lot of detail and a lot of transparency. And that might take a little more work than some people want to put in while they're in a due diligence process. But if you do the work with us, you won't have surprises on the other side. And people that don't want to do that kind of work, maybe they're not a great fit. So there are a lot of things that we have learned over time that allow us to be very thoughtful now, especially about who we bring aboard and why. And the fact of the matter is, Mike, what we're running is a customized business. This is very boutique. It's very high touch, and we just can't do it for everybody. That's just the reality of it. So we're going to pick our shots and try to be somewhere in the 10, maybe 15 deals per year kind of range. And that's what our team can afford to do from a time perspective, and a manpower perspective, and a budgetary perspective, and all the things that you would expect us to look at. But that's enough, and that's really good growth with really, really high quality advisors. And the simple reality is it is very rare for anyone to ever leave. I don't even remember the last time somebody left. It was at least 5 years ago, and I think that says something about us keeping up our end of the bargain, which is that we're going to be here for you. Everyone's got my cell phone. Everyone's got Scott's cell phone. Everyone on the team's numbers are available. And we're working all hours, any hour, to support that business and make sure that the advisors get what they need, just like they would do for their clients. It's really the model.
Thank you.
And, this question I like, and it can go to both of you, Rob and Scott. What advice would you give to these advisors who work at the big boxes at Merrill, Morgan Stanley, who are looking to go independent? Essentially, think back to you guys, 15 years ago. What advice would you give to them?
Yeah, maybe I'll start that. And I think, and Rob, certainly we've got similar views to it, but I think my perspective is I think advisors, it's not as scary to go independent today as it was when we started this thing in 2011. I think the industry has matured significantly, and there are a ton of good competitors. I mean, we compete with some amazing firms out there, and these are a lot of our old colleagues that were at the wirehouse firms and have gone out and built models. I would just tell you, I think it takes time. Do your due diligence. Don't be afraid to find somebody that can consult you and help you make a good decision when you're looking at all the different options, because everybody has a different slant at it. We all do it differently. And guess what? We all believe we're the best at what we do. Okay. So I think, we have our way of doing it with the 4 pillars. We believe in real estate as a core part of what we do into perpetuity. And that's our model. But so many other firms do it differently. Some do it for a year. Some don't do it at all. Some have higher payouts. Some give you capital. I think you've ultimately, my opinion is, find advisors that you trust and you believe in that are independent, ask them why they made the decisions that they did. And in many cases, you're going to find similar things that you're looking for, especially with people that you confide in and you trust. But there are a number of great options. There's a lot of capital out there chasing advisors today. And I think people owning their own business, you have much better happiness at the home life, is what we're told. You have a better lifestyle. You have far better tax benefits. There's no doubt about that, being an independent contractor. And I will tell you, the pride of ownership that Rob talked about, it is something else when we travel the country and we see all these people. I had dinner, last couple of weeks ago with a couple of advisors, and they brought their wives along, and listening to them talk about the quality of life, the cash flow is better, the tax breaks, and overall happiness of owning their own firm. It's really, like Rob said, we get a lot of pride in what we see on that front. So those are my thoughts.
I love that.
Yeah, that's all really good advice. I don't probably have a whole lot to add to that, except the thing that most advisors say most often is, I wish I had done this sooner. So whether it's with us or anybody else, the idea of, if you're thinking you want to be independent, you're probably right, and so whoever you choose to do that with, you're probably going to be better off doing it sooner than later. There are always a million reasons why inertia, keeps us in our seats or keeps us still in any part of life. But if you can break free of that and start putting one foot in front of the other, and there are a lot of good resources available these days that weren't to help people understand the space. We certainly try to be that as well. And we'll tell people all the time, just because we're a hammer does not make you a nail. But we're big revolutionaries when it comes to getting out and getting independent. We're willing to help anybody. Whether you come with us or not is kind of a secondary thing. I'm not gonna spend 3 months helping you, but I'm happy to help and guide and direct and give advice to anybody, whether they ultimately decide to join with us or not. The only other thing I think I could add here is, and this is kind of on the other side of the coin, is it's a lot of this is an economic decision that is driven by what you want. And what I mean by that is, an advisor has a lot of choice these days about how they want to experience independence. So there are firms out there that offer you a call center and a very high payout. And that's a way to do it. And I would say that's kind of a self-service way to do it. And then there are firms like ours that are decidedly the opposite of that, but we're more expensive. So, that becomes sort of an economic decision that an advisor has to weigh. Is it worth an extra 3 to 5 points of payout, let's say, to get all the services that we do for an advisor or for the advisor's firm, versus doing it all on your own? And there's no right answer to that. I mean, there's a reason that Lowe's and Home Depot are successful, and it's because a lot of times people like to do things on their own. And we don't have anything against people that like to do things on their own, but our model is not that. Our model is kind of like, we're the car dealership. When you drop your car off for service, you're getting a loaner, and it's going to be nice, and you know what I mean. And we're going to take care of all of the stuff that you want us to take care of. But it costs more, and why you're paying more. So there are no right answers when it comes to that. That's truly it's a question of, like, how do you want to spend your time? And I think that it's important for people coming out of the W-2 space who don't worry about real estate. They don't have to. They don't worry about technology. They don't have to. They worry about compliance, but not because they have to do any of it, just because compliance seems to always be looking for a way to put a bullet in the back of their head. And they don't worry about, supplies and infrastructure and all that kind of stuff. So all that stuff's kind of built in and ready-made for them. So when you go independent, depending on which side of that spectrum we were just talking about you're on, you're going to have responsibilities more or less for that stuff, and a lot of other things too, but that's just sort of the basics. You kind of have to decide how you want to spend your time. And a great example that Scott always likes to mention is when you call the cable company because your internet is out, and typically the internet is provided by a cable company locally, and you're on hold for 90 minutes, how does that make you feel?
Right.
I mean,
right.
If I'm on hold for 90 seconds, I want to kill someone, but cable companies are notoriously bad. They will keep you on hold forever. If you want someone to do that for you, that's more our way, right? And if you want to do that on your own, that's more your way. And neither one's right. It's just kind of the sort of decisions that need to be made.
So let me ask you guys this, shifting gears a bit, what do you see as the future of wealth management?
Yeah, and that's a big question. I mean,
we should just say us. We're the future. No, I mean, golly, that's a huge question. Wow.
Yeah. I'll get more specific. So, you had said that that there is a big push towards the lift outs of the wirehouses, right? And we've seen a lot of private equity step in, and there's been a lot of consolidation. Do you feel like it's going back to that model, but it's not? It's going to be different names, not Goldman Sachs and Morgan Stanley. More like Dynasty and Focus. I'm just pulling names out of there that are in the news these days. Or Kestra, I should say. Where do you see as the future of what's going on in our space right now?
I hope it's not what happens. Well, look, Scott, I mean, I know you've got thoughts on this. If you want to take the lead, I'll follow you.
Yeah, I mean, I think it's interesting. Our name when they're throwing names out, actually every now and then somebody uses our name, which is great. I smile about that. I get a little warm. But in the end, I think we feel that there is definitely a trend that is going to continue to move people out of the wirehouse independence. Now, look, they ultimately are going to adjust to that, and we believe they will ultimately come up with their own models to try to combat that, if it's an Edward Jones or a Merrill Lynch. But we believe that people want smaller, and they want a full service experience, and that people like lifestyle, and they want to own their own business. And our direction is that AI is very important, and you want the best technology stack you can get to give your clients a different kind of experience that you're not allowed to give them at a wirehouse. And look, I respect what the wirehouse has to manage to. We both manage thousands of advisors, and we know that you can't just let them do whatever they want. And I'm not saying on the independent space we do that, but I do think when you are able to have manageable growth and you only hire senior people with good track records, you have more comfort that we're able to manage. We don't have to manage to the lowest common denominator. So I think our financial planning capabilities, our performance reporting capabilities, our trading capabilities, the ability to use alternative AI to analyze tax returns, trust documents, life insurance policies, all those things that wealth managers want to do but could never charge for. We think the trend line that you're going to charge for your advice is growing up more rapidly than charging on assets. And we believe that the value of advice is going to be more valuable going in the future, not less valuable. But then again, Rob and I are advisors at heart. We love advisors. We know how hard it is to do what they do every day. And so we believe in that. And we try to build a platform that caters to that sort of personality, that enjoys support so they can provide an incredibly high level of service to higher net worth clients. That's our model.
Yeah, and Mike, I think you were talking about too. Another part of what you were saying was, are we all basically just going to turn back into everything that we're leaving? Look, there's some chance of that. I think LPL's dead set on doing that. No offense, LPL, but I mean that's their stated goal. And I think Raymond James is sort of in the same boat. And these are not pejorative statements, but look, everybody needs scale to be more effective, right? The less scale you have, the harder it is to be effective. And we're talking about how to run a business and provide the most resources to advisors that you can provide. But there comes a point where your scale exceeds your ability to offer a real true service model. And that's where we don't want to be. So going back to what we talked about like a million minutes ago, in 2018 or 2016, whenever that was, our advisor count, active count was around 1,300. Today, it's around 1,320. And private wealth has grown like crazy. Now, you remember the demographics of our business are like an upside down pyramid. People are leaving out the top like crazy, just aging out. and retiring successfully. Thank God, good for them, right? They earned it. But if we can keep the advisor count steady or moderated from a growth perspective and grow revenue like crazy, now you're building something that really matters and it has real horsepower, and it's the kind of scale that advisors can hook into and really take advantage of, right? And we're not just jamming everyone into a call center experience and saying, good luck. You know what I mean? Like we'll turn those people over once they get sick of doing this all day with you, and you'll just get a new person in there and you won't know their name and they won't know your name, and it's just going to be what it's going to be, but you're going to get a higher payout. I mean, that's a business model. It's not a great one from our perspective. We're trying to be, kind of the other side of that, which is let's keep the advisor count steady. Let's grow the per revenue per advisor number over time. I mean, that number for us, gosh, over 10 years, it's probably almost double. It's probably gone from, I don't know, Scott, where we started, but maybe around 500 to it's in the 950s per advisor now. So, that's a great trend, and we will take full advantage of that. We don't want to grow. We don't want to grow into what we left. And we are, to Scott's point about our time as advisors, and look, we're surrounded by former advisors, former W-2 advisors every day. We're all sensitive to that. We're not going back to that. And anytime that sort of stuff starts to creep in, believe me, we think it or we hear about it. And so that's the kind of stuff you tamp it down as quickly as you can, and you readdress the service issues. You may have to hire more people. You may have to broaden the offering. You may have to change some economics in certain places. And the last thing I'll say as I kind of ramble through this answer is compliance in the W-2 space is so brutal, and getting worse. And what we try to do is for us, it's more about the administration of the new policies that are coming from FINRA and the SEC and others. It's much more about how we administer those policies than the policies themselves. So what your listeners should never be under the misapprehension or misinterpretation that the independent space is the Wild West. We get audited every year like everybody else, and the rules are the same. And so the same controls need to be in place, and all the things that people are aware of that go into compliance, we do as well. To Scott's point earlier, we don't have a lowest common denominator problem. That's the biggest advantage we have in compliance is, number one, all of our folks have 10 to 25 years of experience before they even get to us. And number two, we take a long time getting to know them, and we pick and choose, right? And so when it comes to how we administer things, we're starting from the perspective that you're an adult and that you're experienced and that we can trust you. And that makes a huge difference when it comes to how things actually get done. So those environments are very different. The wirehouse, our space, because they have to be on a lot of levels. And that's some of the stuff that we also have learned along the way. You guys ask questions about like, what did you learn? And a lot of times we learn like, oh, that's why they did it like that. Even though we didn't like the way they did it like that, we've come to understand a lot of it. And so what we're really seeking to do is navigate around some of those really negative elements of that sort of administration and find ways that we can protect advisors, which is job number one, protect their businesses, right? And then help them grow and flourish in a space that allows them to have the creativity and the ownership that they really want.
The other thing, that Rob and I are really noticing is credentialing. I mean, credentialing like the CDFA, Certified Divorce Financial Advisor, the SEPA designation, the AFI designation to be a fiduciary. These designations, teams are coming to us saying, hey, can you find me a female CFP? Can you find me a female advisor that's a CDFA? And they want to plug these people into their value proposition. So what's happening is they're adding these credentials into their existing client base. That's how they're growing revenue so rapidly, with people that have different expertise on the existing client base that they were ignoring. Because predominantly, many of those designations didn't, exist or weren't allowed early on. So we are seeing a significant push by teams to add people that maybe aren't part of the right team or on their own, a younger trainee from a large wirehouse somebody that's a siloed advisor at an RIA, we're tucking them into some of our bigger firms. I don't know, we did probably 11 of those this year in different firms. And I'll tell you, each one of those, the people are saying how tremendous that has added value to their business exponentially. So that's a big trend we're seeing as well.
Thank you for sharing that. And to close out our conversation today, we talked a little bit about the future of the industry. Let's talk about the current economic environment. Given the current challenges of today's national debt, election, oh my goodness, an election year. I don't know why I'm stuttering so much. The market volatility. What are your guys' prediction for the economy, in the both short term and long term? And how do you think it's going to affect sectors, particularly like real estate?
Well, I'll start by saying we want to at this point, we put a quick plug in for Kestra Investment Management and Kara Murphy. She is our chief investment person that we hired from Goldman Sachs about a year and a half ago, and has built a tremendous business and informs a lot of our thinking on this topic. But I'll speak for myself personally. I think achieving the sort of market returns that we've had the last few years going forward is going to be very difficult. And I think that the debt that we've accumulated post-COVID, during COVID and now post-COVID, is going to be a big factor in achieving those sorts of outsized returns. Inflation, I think, remains a threat. I don't know that the Fed really got it, and I'm not sure that a 50 basis point cut helped in that regard. We'll see as we get into 2025. But I'm cautious. I think that Scott and I both have been doing this for a long time, and the old wisdom tends to prevail, which is you got to buy and hold. You got to stick it out through things. You should have a plan. And when the going gets rough, you should try and stick to your plan and not be emotional. But I'm not super excited about what I think the upside looks like in 2025, and I'm positioned that way. And so I would say for me, it's the standard kind of equity positions that are long-term holds, and then frankly, things like gold and commodities, I think should do well if I'm right about the interest rate environment.
I can tell you we've seen a substantial uptick. I think rates drove it. Fixed income has become a bigger part of people's portfolio now that the rates are higher and people are able to lock in some yields that they weren't able to lock in. So we saw a substantial uptick in fixed income business. We saw a big uptick in structured note business with volatility, the ability to use derivatives to build products that will protect on the downside, but give you that upside, maybe a bit muted upside. We saw a substantial uptick, as well as in the new structured variable annuities that give you some of those same guarantees. And whenever I see those things coming out and more prevalent in portfolios and less, technology, direct equity exposure, we are seeing these other products that are protecting the downside increase as a percentage of people's portfolios, which should tell you probably where most people think ultimately the direction of the market is over maybe the more 12-month intermediate term.
Well, very interesting times ahead for sure. I think that wraps up our conversation today. Rob, Scott, thank you both for joining us on this episode of the What Matters podcast. It's been a pleasure having you on the show. Thank you for sharing your wisdom, your valuable insights with us and our audience. We really appreciate it.
Thank you. We appreciate it. It's been fun.
Thank you so much.
Thank you. And to our listeners, thanks for tuning in to another episode of the What Matters podcast. Until next time, take care. Thanks, everyone.